Now let's talk about analysis for a minute. When you're figuring out the next day where to trade. Well, first of all, use the DBSA. I'm consistent. If you don't understand the DBSA and how to use it, send me an email. I'll be happy to discuss it with you. But there's a lot of information in there. Sometimes I'll go through it very quickly, but as you guys are aware, sometimes I'll get quite expansive, especially if I see something and can make a lesson out of it. Start with daily charts and just, look for the obvious. You don't have to, if you look at a chart for more than about 45 seconds, there's probably nothing there. So start with the daily chart. Look for 4+ day balance areas. Those are always candidates. Then identify the upper and lower extremes of those on those charts and set alerts in those areas. And then, you want to have the next day, if you have your alerts and the alert goes off, it's similar to the situation that I used in gold earlier. If an alert goes off, then you want to see, all right, there's an alert. Let me go over here and look and see what's going on. And that's your trade. That's the market that you want to take a look at trading. Identify markets in early stages of initiative development. You do not have to catch the initial thrust out of a balance area. As a matter of fact, a lot of times you'll avoid getting whipsawed if a market moves a couple days in the direction of the initiative move. And a perfect example, a couple of perfect examples of that, you have the British pound, the Japanese yen, we had the grains last summer. The markets that are trading initiatively are wonderful markets to trade. But again, it requires a different worldview. Most traders see a market that's up or down 3 days in a row, goes, all right, yeah, I'm not going to do that. I'm not touching that. It's overbought, it's oversold. Well, that's not smart. If you see a market that is clearly migrating in terms of value, in terms of development, it's giving you information. It's making it easy for you. And then you can go into those markets and look around, in the grains, look around the day session open, in crude, look around the pit open, copper, the pit open at 810. Use the openings in the day session and see what's happening and see if that opening is in an area of that you've identified the previous night and you've got a good reward to risk trade. There is always, every single day, in some of these markets that we follow, several good setups. Now, invariably, you're going to look at the one or two that don't work out, and the one that does, it's going to happen. It happens to me. It happens to Troy. I see things all the time that I wish I'd caught. Gold was one of them a minute ago. But if you do this consistently, you are defining what you're doing. You're using the methodology. You're identifying opportunity based on market condition, market structure. You are inherently trading with a positive expectancy, and it's a process. It's your job. It's structure. It's not just, well, gee, tomorrow morning I'm going to walk into my workstation, turn on my computers, and start whipping stuff around. This is not a video game. This is a very, very serious business, and if you approach it as a serious business in a methodical way, you can do really, really well. You talk about bonds, James. Yeah, let's look at bonds. That's a good point. I knew you were trading bonds. Good for you. That's awesome. Now, you can go back and look at the DBSA. We were talking about this. And we had this highlighted, and then we formed this balance area. Now, James, walk me through this. So, Raj, you caught this trade too? That's awesome. Okay, look, give me a time for this was an area that was tricky. I know we had this discussion in the room. Correct me if I'm wrong, James, but I think you got stopped out in here, didn't you? Did you not? This is one of the areas. Yeah, we had this discussion in the room because one of you guys had gone long and then stopped out because it retraced. But, you know, again, this is trade location, and when this what this turned out to be actually was a false breakout. Now, this was a little tricky because you had the buying tail, but it did not take this out. And then when it fell out of here, I mean, that was a great trade. So I guess this is the trade you took, James. Raj, where did you get in this? Troy wants to talk. I'm going to unmute you, Troy. I just saw it. So you're short from 143 right here. Great. Troy, I have you unmuted.
Yeah, you covered it. I was just going to point out where I think they got short, but you've got it labeled.
Okay. Okay. Now, we had this discussion in real time in the room.
Yes, yes. That's something that we had, pointed out in the room when I did the pre-market that morning. The low extreme, or the small degree structure at the low extreme of the larger degree structure. Worked out nicely.
Right. Well, while we're on the subject, bonds have traded into this HVM below here.
Yeah, I told people this morning if they were short, that was my target. At least for a partial.
Right.
From the original position. So.
And we have the this number tomorrow too. So that's if I have a position in bonds, that's a really good reason to at least take a partial profit. On the other hand, if bonds were to trade below this level, oh my gosh. Now, since we're on the subject, and I didn't intend to go there tonight. This is something we're going to talk about next week. But if you're in a position like this and you're in front of a number, you could go delta neutral with your position by buying. Let's say you're short. You could buy, or you could do it partially. You could buy an at the money call. You could buy 2 at the money calls, which would put you delta neutral. And then tomorrow, you would have, what you could do, you could let the noise die down to see what was going on, and you could cover the side of the trade that you needed to cover. Now, that's a little bit out of the scope of what we're going to talk about tonight. We're going to talk about it a little bit next week. But there are ways to manage trades and to hedge your positions when you're in a trade and it's working and you're coming up against an obvious, exogenous event like a report that is very likely to roil the markets, but it could be in your favor too. Okay, so we want to, in our analysis, we want to identify the markets that are in the early stages of initiative development. And this gets back to another difference in our worldview. We're focusing on what is rather than what might be. Stick with the probabilities. The probabilities are that a market or markets that are in clear development directionally are going to stay in clear development directionally, and that's the path of least resistance, and that's where there is an inherent edge. So once again, you're defining what you're doing. You're defining your business. You're a professional. If this is your chosen method to apply your profession, then use it. Stay away from this prognostication stuff. I mean, the obsession with predicting markets, I guess as humans, we're hardwired to want to predict things. It's some sort of evolutionary trait or something, I don't know, but it really gets in the way. A predictive mindset is the most dangerous thing a trader can have. I read an article on Market Watch 2 days ago, yesterday, 2 days ago, and there's a guy there on there that's he's a pretty well-known guy, a young man, and very successful money manager. And he has been writing a series of articles. He's just indignant that Apple won't bounce because it has so much value. They have so much cash. Well, he has a different worldview than we have. And there's nothing that he has ever bought that we could not have bought using what we're doing. But if he had been using what we're doing, it would have probably saved him no telling how much money. So we are dealing in what is as opposed to what might be. Very powerful worldview. Now I'm going to share with you a little secret here. The 3 most liberating words in the English language. This has trading implications, but it also has implications in other areas of your life. I don't know. Be willing to look at a market and go, I don't know. I don't have a clue. You'll hear me say that. Sometimes I just don't know. How could you know all the time what a market is doing? So, be willing to say, I don't know what's going on. If I don't know, I'll just look at another market. It's impossible to know what's going on. I can't trust people that know everything about everything. So you don't have to know everything because you never will. No matter how long you trade or what your aptitude is for trading, you're never going to know it all. But you don't have to. Just trade what you know. You've heard me say this over and over and over. You will be able to trade more and more and more just naturally without trying to force it. When Troy is talking about a trade in the room, if you don't know what he's talking about, don't take the trade. Just sit there and learn something. Just listen. Don't feel like you're missing anything. You're learning something. You don't have to trade everything that I suggest or everything that Troy points out. Trade what you know. And that's the best purpose. We're here to educate you. We're not here to trade for you. And when Troy's talking about trades in the room, the explicit reason he's doing that is for educational purposes. And we're not saying that to cover our butts. It's true. Our goal is to get you to the point that you really don't need us, that you're sitting there, and when Troy says the words Australian dollar come out of his mouth, you know what he's going to say before he says it. So just trade what you know now. The rest will come in the fullness of time, and accept the fact that you're never going to know it all or be able to trade it all.